Relief for the UK and Europe as an extra US tariff over Greenland seems off the table for now. President Trump says a threatened 10% tariff on UK and European imports to the US now won't kick in on the 1st of February after he came to a framework deal with NATO over Greenland, but it's not clear what's in it. There was also some relief for the UK government on Thursday morning as borrowing came in lower than expected because tax revenues are higher. This week has seen a mixed bag of economic data, though, with higher inflation and lower employment. James Smith is a developed market economist at ING. James, the immediate trade threat from President Trump seems to have receded for now, but has this week shown the UK needs to further rethink its trading relationship with an increasingly erratic US?
I think it goes to emphasise that in the UK's case, it's not the tariffs themselves that necessarily matter, it's all the uncertainty that goes with it. And I think European leaders, UK, but also the EU as well, did those trade deals last summer in a bid to reduce the uncertainty for companies. You know, they weren't necessarily the sort of, necessarily all in the UK or EU's interest, but they did at least kind of create a bit of continuity, a bit of certainty. And obviously that's all been thrown up in the air. And even though we've had this sort of postponement of the 10% tariffs, let's see what happens over the next few weeks. It kind of feels like this story might not be over yet. So yeah, that uncertainty, that is an issue for Europe.
This week here in the UK, we've seen weak employment numbers and higher inflation. Is this painting a concerning picture?
I think the jobs market has been weak for quite some time. We've seen a gradual fall in private sector hiring all the way through 2025, down about 1 percentage points. This isn't really new. It is still quite gradual, but the hiring surveys are still pretty weak. It's very much concentrated in hospitality at the moment, sectors affected by last year's tax policy changes. So it's something we've got to watch. At the moment, the good news is we aren't seeing a big spike in, for example, redundancy. So I think this is more about attrition at the moment rather than something more worrisome. But, it is going to keep a lid on UK growth this year.
Why, though, do you think that hiring continues to look so weak?
Well, as I say, it is partly a legacy of those tax hikes we had last year and also the big increase in national living wage we saw last April. Now, neither of those things are being repeated, or at least not to the same extent this April. So I think that is a part of it. That global environment also having an impact as well. So let's see. I think one of the focuses this year, if you wanted to kind of paint an upside risk for the UK, it is that the Bank of England has started cutting rates. Thus far, we've not really seen the impact on growth, but you could imagine, household and business balance sheets are fairly healthy. If you want to be optimistic about the UK, maybe some of these numbers turn around later this year as those rate cuts begin to hit.
How is the Bank of England reading this week's data, though, especially that slightly higher inflation number?
Well, I think they won't take too much away from those inflation numbers. They were slightly higher than expected, but there is a bit of noise under the surface as well. Food inflation did pick up in December, but it is still well down on where the bank expected it to be. And that's really important because the Bank of England, particularly the hawks, were worried about rising food prices last summer. Would that translate into higher inflation expectations? Would that give us an inflation backdrop that was more persistent, a little bit like we saw 2 or 3 years ago? Those fears now look overblown. And what we're going to see over the next few months is inflation is going to drop quite dramatically. We're at 3.4% now. I think we're going to be below 2% in April. So a lot's going to change.
When, though, are you seeing that next cut from the bank? And indeed, how many this year?
We're expecting 2 more cuts. I think they could come in March and June. I think by March, we're going to have 2 more jobs and wage figures. The jobs numbers we mentioned are already weak, but also the wage numbers have been really benign as well. That private sector wage growth looks like it's going to drop to, say, 3% over the coming months, down from 6% at the start of last year. So if we keep seeing that over the next couple of months, that should unlock a March move. And as I say, if headline inflation really does come down as we and others expect, then June should also be on the table too.
That was James Smith of ING. Don't forget, you can watch more videos on Reuters.com.